Your next guest is looking into the implications the budget bill could have on stocks and your money. He says we could see higher Treasury premiums, which would ultimately impact valuations. Bring in Scott Chronert. He is the head of U.S. equity strategy at Citi. Scott, I guess, put that sort of connect the dots, because the reality is what Emily and everybody's been reporting about this bill doesn't exactly show fiscal discipline. And with all this debt and deficits, Treasury yields they have to keep climbing, maybe.
Yeah, thanks, Brian. So the connect the dots angle here is that we're going to have roughly a $2 trillion deficit this year. Under Trump 1.0 and the TCJA, if those were to expire at the end of this year, essentially the budgeting baseline allows for the tax increases that give you another wave of spending to offset some of that deficit math. But when you go down the path of extending the TCJA, what essentially that does is imply a net negative to that deficit number. So you need some combination of spending cuts to offset that. That's not really happening. So the way our math is going is that we think that the proposal as came out of the House adds another $600 billion or so to next year's deficit. Now, that's the bad news. The good news is we actually now have tariffs beginning to kick in. And our math is that tariffs could offset about $200 billion of that. So what ends up happening, all told, is that you go from this TCJA extension, some puts and takes in terms of some other tax cuts, some modest spending reductions, the tariff income, and you're back to about a $2 trillion deficit, which is where we are this year. What that does from our perspective is two things. It means that financing this deficit is going to require ongoing higher Treasury issuance, which means higher interest rates, potentially valuation overhang. On the other side, though, it's still a positive fiscal impulse, which net is good for the economy, economic conditions, and most importantly, S&P 500 earnings.
Is there a part of this story where a 10-year yield at 5%, some CDs at 4.5%, whatever the number is, where do people, some of your clients, say, Scott, I love you, but I can get a risk-free 5%. I just don't want to risk it in stocks. Is that kind of where the damage or the risk may be for the equity market, the competition for the money?
Yeah, I think that's spot on, right? That's where this goes, whether it's treasuries or whether it's the corporate bond market. But you begin to look at the income opportunity that you get as rates back up, and you weigh that versus an expected return on stocks. And again, that's where this valuation overhang comes in, because at the end of the day, higher rates, presumably from a discounting of future cash flows perspective, draws down or keeps a lid on where equity market valuations can go. So, Brian, you're spot on. That's where we're going to be going. All told, our view as a result is that we think the S&P is currently around, let's call it a fair value range, about 23 times trailing earnings. We're going to have these puts and takes unfolding over the summer months where we're going to be responding to incremental information that adds or detracts from this deficit versus growth narrative.